Greetings, members, one and all of the Salivation Nation. Inflation rears its ugly head, and gold will shine. Let's explore. Yes, indeed. The news is out about inflation. It is not just transitory anymore. It is really rearing its ugly head here in this article from CNBC that talks about how consumer price indexes, the CPI, increased 5.4% in June from a year earlier. That's the biggest monthly gain since August of 2008. And you know what happened around that time? Well, December of the prior year was the beginning of the financial crisis. This is coming to us from CNBC, and we're doing this report as the Dow has closed 100 points lower as hot inflation report overshadows stronger earnings. And that just goes to show you, folks, that little headline right there is the tail of the tape. Think about it. If you're getting a raise at work, and that raise is a 3% increase, well, that's a little bit more than what the usual cost of living is. But then we see that inflation is 5.4%. That's not doing you a whole lot of good. In fact, you're losing out. If you have money in savings, well, that's going to make it even worse because that money is not growing for you. In fact, just having it there is losing value. Inflation surged in June at its fastest pace in nearly 13 years amid a burst in used vehicle costs and price increases in food and energy, the Labor Department reported Tuesday. The Consumer Price Index increased 5.4% from a year earlier, the largest jump since August of 2008, just before the worst of the financial crisis. Economists surveyed by Dow Jones had been expecting a 5% gain. Stripping out volatile food and energy prices, the core CPI rose 4.5%, the sharpest move for the measure since September of 1991, and well above the estimate of 3.8%. On a monthly basis, headline and core prices rose 0.9% against 0.5% estimates. Stock market futures fell following the report, while government bond yields, which have been down precipitously, were mixed. What this really shows is inflation pressures remain more acute than appreciated and are going to be with us for a longer period. So transitory has, well, temporary. How long is temporary? Temporary could mean 1 year, potentially. Who knows? Or it could be 1 decade. It's a very loose term, I think, and maybe that's how they'll kind of define it. Well, when we said temporary, transitory, we were meaning that it could last a couple of months. But nonetheless, Sarah House, senior economist for Wells Fargo's corporate investment bank, we are seeing areas where there's going to be an ongoing inflation pressure even after we get past some of those acute price hikes in a handful of sectors. A separate report from the Labor Department's Bureau of Labor Statistics noted that the big monthly hike in consumer prices translated into negative real wages for workers. Real average hourly earnings fell 0.5% for the month, as a 0.3% increase in hourly earnings was more than negated by the CPI increase. Inflation has been escalating due to several factors, including supply chain bottlenecks, extraordinary high demand, as the COVID-19 pandemic cases eased over year-over-year comparison to a time when the economy was struggling to reopen in the early months of the crisis. Policymakers at the Federal Reserve and White House expect the current pressures to begin to ease, though central bank officials have acknowledged that inflation is stronger and perhaps more durable than they had anticipated. Well, it's not been a surprise to many of us here in this community, for sure, because whenever you digitize, and that's really what they're doing. They're not printing as much extra dollars because a lot of people aren't using cash these days. But whenever you digitize more money, well, it's going to dilute the money supply. And what does that mean? that can only mean really one thing: inflation. And that's what's happening. And they can only do so much of that where it goes up and props up the stock market and props up foreign investments and foreign countries, to where it's going to come back eventually to bite us. Because remember, we had 3 rounds of quantitative easing before, where a lot of that essentially did work. We got off by the skin of our teeth there, essentially. But nonetheless, it is what it is, and it will be what it will be. And that is what we'll talk about here next. So we're not saying, according to the White House economic advisor, that the pandemic-related risks aren't real. We're not ignoring them, but we're also trying to put them into a longer-term perspective, because the underlying price index outside the pandemic-affected areas is quite tame. Well, they've been pumping this out. Look what with the repurchase agreements that they did. They pumped over about $700 million back about September and December of 2019. Fed Chairman Jerome Powell likely will be asked for his views on inflation when he speaks Wednesday and Thursday to separate House and Senate panels. Powell has been steadfast that inflationary pressures are primarily transitory, though a Fed report Friday indicated that upside risks are increasing. This does increase some of the jitters among some Fed members, Wells Fargo House said. We already saw they were getting more worried about inflation at the June meeting. If you parse through this, there are a number of areas where inflation is picking up and likely has staying power. That's going to make some folks nervous. Much of the price pressures have come from sectors particularly influenced by the shutdown: used car prices, airfares, and transportation costs, to name 3. That was the case again last month, as used car and truck prices leaped 10.5%, accounting for more than a third of all the price index's gains. For a 12-month period, used car and truck prices have burst 45.2% higher. So when you see these things, people are trying to find a bargain. They can't afford a new car because this prices are going up too. They're going to get a used car. And that demand has caused the prices to go up. Food and energy prices were also up substantially, and gasoline index rose. Housing and shelter prices continued to climb, adding fuel to the belief that inflation could stick around for a while. Shelter makes up nearly a third of the CPI, and increased 0.5% for the month and 2.6% from June 2020. Consumers see prices overall up 4.8% in the next 12 months, according to a New York Fed survey released Monday. So that's a New York Fed survey. Although a separate survey from the Bank of America out Tuesday indicated that professional investors are more inclined to believe that inflation will be temporary. Well, that's kind of interesting. But nonetheless, gold prices are reacting a little bit here. Gold prices climbed on Tuesday, according to this article from MarketWatch, to recoup most of the losses suffered in the previous session. Rising inflation should help to support the precious metal, as it is seen as an inflation hedge, said Fawad Razadada, market analyst at Think Markets. High inflation is not necessarily a good thing for gold if it means the Federal Reserve is going to tighten its belt, raising the federal funds rate, he said. And that is something that I wanted to talk about with this, because here are the prices. And right now, gold is the only metal other than rhodium, which is now nearing $20,000 again. But gold is only up $1.10 on the news right now. And that means that potentially they may be foreseeing, and maybe that's what silver, platinum, and palladium are doing, foreseeing that there's going to be a chance the Federal Reserve may react. And we'll find out what Jerome Powell says in these hearings, and perhaps they're going to be tightening up a bit to try to push back from this, and that is going to strengthen the dollar potentially, which means it will have an effect on gold the opposite direction. But gold will shine, folks, because sooner or later the Fed is going to run out of their little tools that they have, which essentially, they do to try to control the economy, and because that's essentially what they're doing. But they've done so much damage, I believe, that there's not much they can do. More they can do, and it was going to get away from them. Now, am I saying there's going to be hyperinflation? No. I believe there's some resiliency within our economy that will guard that to at least some point. We're insulated at least to some level, mainly because we are the top dog in all the currencies out there. We're the cleanest dirty shirt in the basket of laundry out there. We still have a dirty shirt. We still have problems. And but nonetheless, I believe that gold will shine on. And even if we see inflation go even worse, if it goes up another 25% more from here in the next measuring period, we could potentially see gold go down and silver go down. But already, silver's kind of reacting to kind of what I think that gold may do, at least in the short term. But nonetheless, no matter what happens, but especially now, and especially with this uncertainty out there, gold will shine. And even though silver is not shining right now as it's down a quarter, that's almost a full percentage point on the day, it will shine too. But its volatility with gold, sometimes it does run in opposition, and that's kind of what we're seeing here. And part of that, there could be other factors at play that are affecting silver in the opposite direction than gold at this point. But nonetheless, that does widen the gold to silver ratio to 69.63. And this is as close to 70 as I've seen it in a little while, and which will frustrate some silver stackers. But nonetheless, the encouraging news here is that gold and silver will do what they have always done if you hold it long enough, and that is as an inflation hedge. That is to protect you against economic instability. They preserve their value over the course of long periods of time. So there you have it. So inflation is doing its thing, and we will continue to do our thing. Do I still think it's wise to hold a little bit of cash? Yeah. But you know what? It may not be a bad idea to hold some of that cash outside of the banking system. And I believe definitely in putting some money into gold and silver to protect yourself as well, or other areas where you think that may be a little bit more risky, that could keep up with or surpass in the inflation rate. So there you have it. Let me know what your thoughts are in the comment section below. Would like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.